Thank you, Madam Chairwoman. Thank you, Mr. Chairman Powell, for being here today. I want to stay on the topic of inflation. As you know, I've been a bit of a broken record on this issue because it's so important to families in Wisconsin and across our country. In fact, the prospect of rising inflation, I brought this up in our committee last July, again last December. And in those meetings, you continue to suggest that you're not ready to take action to head off inflation. And yesterday, we received more data confirming that prices are continuing to rise. And inflation is not an abstract concern. And although the White House social media team put out information that a 4th of July barbecue went down 16 cents from last year, and the Biden administration can claim what they want, but families are seeing rapid price increases with their own eyes. Now, I know it's not your role to comment on fiscal policy, but I'm very concerned with President Biden's spending plans and its impact on inflation. Last month, increase in consumer prices of 5.4% was the largest jump that we've seen since August of 2008, right before the financial crisis. And over the past year, used cars have gone up 30%, plane tickets have gone up 24%, shoes are up 7%. We've seen increases in coffee and sugar, cotton, propane, all double digits. And higher material costs have added $36,000 to the price of a new home. And I know you've responded to inflation concerns by saying that price increases we're seeing are temporary and they'll subside as supply chain and labor markets return to normal after COVID. But even if it's partially a case that inflation expectations may be changing and rising the prospects of a more persistent impact. In fact, a poll conducted recently showed that 87% of Americans said they're concerned about inflation. And on Monday, the New York Fed reported that consumers expected to see higher inflation over the medium term. Can you comment on how the Fed responds to signs that consumers are beginning to expect more persistent inflation?
Sure. So we think inflation expectations are very, very important. In a way, if businesses and households think that inflation should be 2%, then it probably will be 2% because they'll expect that and they'll demand that in effect. So we monitor, inflation expectations, surveys of households, surveys of experts, the market. You can, as you know, you can get inflation compensation readings out of the difference between tips and regular treasuries. So we look at all of those things. And I would say they all went down as a group at the beginning of the pandemic, which is not good. And they've all moved back up as a group just about to the level that I would say that is consistent with in the range of consistent with our 2% inflation goal over time. And so we watch this very carefully, and we would be very concerned if they were to move persistently and materially above 2% and would react to that.
So let me build on this discussion. I want to just build in here to the distinction between the transitory and persistent inflation, in particular as it impacts home prices. According to the Case-Shiller Index, home prices have risen more than 14% over the past year. That's a very significant increase, and it's enough to put home ownership out of the reach of some Americans. Meanwhile, the Fed is continuing to buy around $40 billion in mortgage-backed securities. And here's my concern: if inflation is, in fact, as you suggest, temporary, does the potential abatement of inflation present a potential for a reset of housing prices? And if so, what are the likely impacts both on homeowners and what will be the impact on the Fed's MBS holdings?
So housing prices, as I'm sure you know, don't go directly into inflation. That's an asset. Housing is an asset, and housing prices, that's not a factor in inflation. What's a factor is rents. And then, in effect, what the economists do is they take the value of a home and they impute a rental cost to that, and they add it in. It's just the way they do it. So, housing prices, they went up overall 15% last year. That's too much. That's much higher than would be a normal level for housing prices to go up. I don't know what housing prices will do in the future. But there's just a lot of demand. There are people want to live as they want to live in the suburbs now. They want to move out of cities. They want bigger houses. They've saved all this money because they couldn't travel and go to restaurants. So there's a lot of demand. So even if mortgage rates go up, as they ultimately will, I think we'll be looking at a lot of demand. Then the question will be how much supply can be brought to the market. And that's really out of our control. But as you know, if you look around your district, it's a question of zoning, it's a question of materials, labor, all those things.
Shepard Smith here. Thanks for watching CNBC on YouTube.